Good morning, and welcome to Rockwell Collins' third quarter fiscal year 2014 earnings conference call. Today's call is being recorded. For opening remarks and management introductions, I would like to turn the call over to Rockwell Collins' Vice President of Investor Relations, Ryan Miller. Please go ahead, sir.
Thank you, Mike, and good morning to all of you on the call. With me on the line this morning are Rockwell Collins' Chief Executive Officer and President, Kelly Ortberg, and Senior Vice President and Chief Financial Officer, Patrick Allen. Today's call is being webcast, and you can view the slides we'll be presenting today on our website at www.rockwellcollins.com under the Investor Relations tab. These slides include certain non-GAAP financial information and a reconciliation to the related GAAP measure. Please note today's presentation and webcast will include certain projections and statements that are forward-looking. Actual results may differ materially from those projected as a result of certain risks and uncertainties, including those detailed on slide 2 of this webcast presentation, and from time to time in the company's Securities and Exchange Commission filings. These forward-looking statements are made only as of today, and the company assumes no obligation to update any forward-looking statement. With that, I'll now turn the call over to Kelly.
Well, thanks, Ryan, and good morning, everyone. Let me start by saying that I'm pleased with our third quarter results. We grew our top-line sales by 12% and delivered total segment operating margins greater than 20%. And due to the improved earnings expectations for our new information management services business, we were able to once again raise the midpoint of our earnings per share guidance. You know, I think these results demonstrate that the growth strategies that I highlighted at our Investor Day in March and we discussed during the last call are working. Let me briefly remind you that those growth strategies are in 4 primary areas. First, leveraging our new growth platform of information management services. Second, capitalizing on the market share gains with the new OEM platforms that will be entering into service. The third area, expanding our international business. And fourth, positioning for the new defense environment. And during this past quarter, we made progress on all fronts, and let me highlight a few specific examples. I'll start by giving you an update on our information management services business. Here we continue to make good progress in achieving our integration objectives, and as I mentioned last quarter, we're already realizing some of the short-term synergies. During the quarter, the legacy ARINC business had an adjusted EBITDA margin of 21.6%. And its commercial and business aviation portfolio grew 13% on a pro forma basis. And remember that the aviation portfolio that grew 13% here is the economic engine of that segment. So I feel really good about coming out of the chutes with 2 good quarters, and I remain encouraged about our ability to leverage this new growth platform. Moving now to the OEM front, during the quarter we achieved a number of important milestones on new programs in both our commercial and government markets. Last week at Farnborough, it was announced that we were selected along with BAE Systems to provide the integrated flight control electronics or fly-by-wire system for the new Boeing 777X. This is a great win and is just the first of what I hope will be more to come for this new airplane. And this is the first selection, so we're one of one, and I like our chances of gaining share from what we have today on the legacy 777 aircraft. In business aviation, we recently completed all of our development and certification work for the Embraer Legacy 500, and that's expected to receive type certification within the next few weeks. This will mark the 4th Proline Fusion-equipped aircraft to enter into service, following the Gulfstream G280 and the Bombardier Global 5000 and Global 6000. And all told right now, we've got about 150 aircraft currently flying with the Proline Fusion system, and we're getting great feedback from the users. And there's still more than a dozen aircraft types yet to roll out, so we've still got a lot of Proline Fusion growth in front of us. Now, on the government side, we recently just delivered our Generation 3 helmet-mounted display system to Lockheed for the F-35 aircraft. We've overcome all the technical challenges associated with this new technology, and this Generation 3 baseline will deliver improved performance for the pilots. We're also making good progress on a number of other key programs in government systems like the KC-46 and KC-390, where we're now finalizing our systems and getting ready to transition those programs from development to production. Now, preparing our government business for the future defense environment means that we've got to go out and win and get positions on new programs, but it also means we've got to take a hard look at our existing portfolio and shape it in a way that'll accelerate our return to business growth. Earlier this year, we divested of Kaiser Optical Systems, or COSY, and as you read in the release this morning, we've entered into agreement now to sell our military satellite communication systems business, formerly known as DataPath, and they manufacture and service ground-based satellite communication systems primarily for the U.S. Army. This business has declined rapidly over the last 3 years due to the wind down in Iraq and Afghanistan, and it's been a major contributor to our overall government systems revenue decline. This move is a part of our strategy to reshape our government systems business to focus on the core products and solutions that best fit our plan for future growth. With the DataPath divestiture, we've revised our outlook for government systems to now be down low single digits from the previous mid-single digit decline guidance. It also takes a major future headwind out of the equation for our government systems business. Now, before I turn the call over to Patrick to walk you through the financials, let me briefly address what's going on in our various end markets. There really hasn't been a lot of change in our outlook for government systems. A couple programs that I've highlighted in the past that we've been keeping a very close eye on are the KC-10 avionics upgrade program and the JTRS Manpack program. We did have a milestone decision meeting for the production approval of the KC-10 upgrade program in the last quarter, and we've got a few minor action items to clean up there before getting contract turn on. So that's really good news on the KC-10 front. This will drive hardware sales for us in fiscal 2015. On the JTRS Manpack program, we do need another LRIP lot to be awarded to bridge to the full-scale production program that's now got delivery slated out in fiscal year 16. So without another LRIP lot award, we'd likely see another production break like we've experienced this year on our Manpack production. And this could have a couple points of impact to our overall government systems fiscal year 15 revenue. So we continue to work this issue with the Army, but as of yet, we don't have a definitive contract or a commitment from the Army for another LRIP lot. So that's something we continue to work over the next quarter. Now, in business aviation, we saw mid-single digit growth in the aftermarket and a flattish quarter for OEM sales. During the last few quarters, we have seen BizJet service and support be a relative area of strength as a number of aircraft that were sold in the prior peaks of the cycle are rolling off of warranty, and we do expect that trend to continue. As I look ahead, we expect a very challenging environment in the light end of the OEM market, but do anticipate continued relative stability in mid and heavy BizJets. And as we've said, we do expect the growth in this area to be fueled by new entries into service. And then finally, the air transport market continues to be very strong, with OEM growth driven by deliveries on the Boeing 787. And in the fourth quarter, we expect to see Airbus start to ramp up the production for A350, which should give us a little bit of revenue lift yet this year, but will be a fiscal year 15 growth story for our commercial business. In the aftermarket, the market's playing out about as we expected. We're seeing the non-discretionary MRO being driven by traffic, partially offset by impacts of recycling. And on the discretionary side, we're seeing good demand for the European mandates, and of course, sparing is driven by timing of new aircraft delivery. Our original production or projections for the full year aftermarket was mid-single digit growth, and that's about where I expect that we'll end up. So in summary, this is another solid quarter, and our teams are executing our plans to accelerate growth and increase share owner value. So with that, let me turn it over to Pat to walk you through the details of the quarter.
Thanks, Kelly, and good morning to everyone as well. I'd now like to walk you through today's presentation slides that summarize our results for the third quarter of 2014. I'd like to begin on slide 3, where we highlight our total company's third quarter sales, earnings per share, income from continuing operations, and shares outstanding. Total company sales for the quarter increased $132 million, or 12%, compared to the third quarter last year. Our third quarter sales included $134 million of revenue from the AirInc business acquired in December of this year. Income from continuing operations and earnings